Carlson. He's free. He's in.
We got a whole new ball game, Matt.
"29-yard touchdown run. Ben Carlson, 21st touchdown of this, his junior season." And you
Welcome to Ask the Compound, where we answer questions directly from you, the viewer. On today's show, we're doing a deep dive into the U.S. government finances, questions that we've been getting for years and years and years. We're going to put them to bed today. How worried should we be about U.S. government debt levels? Are there any easy fixes in fixing government debt levels? Is the deficit all that's driving higher stock prices? I've been hearing that a lot lately. How inflationary are Trump's proposed tariffs? And what are the interest rate implications of everything? Email us, askthecompoundshow@gmail.com.
Getting
Today's
political.
show.
This should go well.
Hey, we're totally unemotional finance-based brains here, right?
Yeah.
The party I subscribe to is the stock market party. Not a Democrat, not a Republican. I'm a stock market follower.
Love it.
Today's Ask the Compound is brought to you by Public. Go to public.com. You can lock in 6% or higher yield with a bond account. Higher bond yields promised to no one. Cash rates are falling fast as the Fed continues to cut rates. We just got another 25 basis cut last week. So if you want to lock in 6% or higher with a diversified portfolio of high yield and investment-grade corporate bonds, take a look at a bond account at public.com. Good news, it only takes a couple minutes to sign in at public.com. Once you lock in your yield, these are individual bonds, so you can earn regular interest payments even if rates decline. Lock in those long-term bond yields at 6% with a bond account at public.com/compound. You can also check out public.com/ATC. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more information. All right. No one's going to be mad at this episode at all, I promise.
No. Everyone's going to be super
level-headed.
Chill. Super chill.
Emotions have calmed down.
Before we get going there, I just wanted to shout out, we have apparently a big audience at Florida Gulf Coast University. Professor Kofer's students are watching the show now. Even got a question from one of them maybe we'll use in the future. So thanks all of our college students out there, but yeah, especially Professor Kofer's class.
Right on the Gulf Coast. I will visit anytime you want me to. Bring me down anytime you want. I'd be happy to talk to the whole class. Once a month. Only in the winter, though. Only in the winter.
Sounds good.
All right. Let's do a question.
All right, up first today, we have a question from, where's the name? Losing the name. How worried should we be about government debt levels? People like Paul Tudor Jones and Elon Musk keep talking about how we're going broke, but what is the catalyst for an actual crisis here?
All right, let's bring on someone who's taught me more than anyone else about how the macroeconomy works, Mr. Cullen Roche.
Hey,
Cullen, I would say that you were from Pragmatic Capitalism, but I think you've sunset that blog. Is that correct?
I have. Everything's kind of transitioned to the Discipline Funds website now. So got too hard managing all those blogs. I don't know how you guys manage all the media you're handling.
Well, we have people behind the scenes like Duncan doing it for us. I've always appreciated your thoughts on these topics because you look at it from a very unemotional perspective. You're not looking at it from a partisan lens. I think a lot of people look at the government debt levels in extremes. You could have some MMT people who say, hey, don't worry about it at all. It's fine. Government debt level, we can run it up as high as we want. The hedge fund guys are constantly calling it a crisis. I think it's okay to think that government debt is too high without assuming that it's going to lead to a calamity. So what is your take here on the levels of government debt we're at now?
Yeah, I think context matters enormously here. So I think the first thing, you guys have talked about this a good amount in the past, the U.S. government is the global reserve currency issuer, and we do not have any foreign debt. So this is crucial because I think that bankruptcy is not really an issue. I mean, we should all be able to agree that we can quite literally print the dollar whenever.
Right, we're not a household.
So, yeah, so being able to pay for things is never really a worry in terms of like nominal dollar printing. And so the second thing that I think is really important, and you alluded to this with the household comment, is that the government is a huge aggregated sector. And so when you look at the aggregate economy, for instance, or even just large aggregated sectors, like think of the three primary sectors, the corporate sector, the household sector, and then the government sector, none of these sectors pay back debts in the long run. So like I sent you guys a chart of private sector debt. And what you'll notice with this is that this chart pretty much always goes up in the long run, so that while an individual household can technically pay back debt, what's going on underneath the surface is that other households or corporations or other entities are borrowing in the long run. And so balance sheets balance. You've got assets, you've got liabilities. What really matters is that how are we using these assets and liabilities in the process of borrowing to create real wealth, to build real resources, build net worth through building corporations, innovating, things like that. And that's the thing that matters. The balance sheet is always going to expand in the long run, assuming the economy is healthy. So you've got to look at it in more context than just looking at one side of the balance sheet and then saying, look, number go up, this is scary.
Right. If the economy continues to grow, guess what? Government debt is going to be way bigger in the years ahead.
In all likelihood. I mean, this is where the debate gets sticky. Is you can argue about what's the right size of the government. Should the government run large deficits? Should we run smaller deficits? Should we run surpluses potentially, especially during boom times? That's all a relevant debate. But the probability that the government and its balance sheet is going to get larger in the long run is very high, just because the private sector, as it gets bigger and more complex, it, by virtue of just sheer size, it needs more firefighters, it needs more policemen, it needs, more people to be in the court system to help navigate, the rules and regulations of all this stuff. So the size of all this is a relevant debate, but the likelihood that it's going to expand in the long run is not necessarily a bad thing.
And the crisis that the hedge fund and billionaires are always talking about, the U.S. going broke, is they think there's going to be this day of reckoning where people stop buying treasuries and they say, all right, we're giving up. The U.S. dollar is no longer the reserve currency. That's when calamity is going to hit. And your point is always well, sure, what's the alternative? But also the big risk is really not that day of reckoning, but more that inflation is the constraint here, right? So the big risk, since we can literally print our own dollars, is the big risk is always going to be inflation. If the government spends too much, inflation is going to be the risk that bites them in the butt.
Exactly. Yeah. So, I sometimes take digs at the MMT people because I think they kind of go too far with a lot of this debate, but this is something they get 100% right, that the true constraint, especially for a country like the United States, that we don't borrow foreign currency, we don't really have an external constraint in a meaningful way because we're the global reserve currency issuer. It's all about an inflation debate at that point. And that changes the context of the entire debate, because once you start focusing on inflation, then you have to start looking at causality. And I think this is where a lot of people get this wrong, is that they look at the size of government debt or the deficit and they immediately assume, well, that's the cause of all the inflation in the world. And it's more complex than that. In fact, I would argue that there are other macro factors that, even if you assume that government debt and this so-called money printing causes inflation, let's just say it causes a baseline inflation of 3% per year, there are other factors that to a large degree offset that. Primarily, and this is the biggie that people miss, is that when we talk about especially reserve currency status, people misunderstand the fact that the United States is not the reserve currency issuer by, it wasn't something that was bestowed on the United States. There's a lot of conspiracy theories about Bretton Woods and the petrodollar, and that's probably truthful to some degree, but the main driver of reserve currency status is just the sheer size and prowess of the United States economy. We have the wealthiest consumers, the biggest consumers, the most innovative economy that human history has probably ever seen. And so the demand for dollars, the demand to do business with the United States is gigantic. And we're the reserve currency because of that. And so I think when you start to argue that the demand for the dollar is going to collapse, you're sort of implicitly arguing that the productivity or the innovative beast that has made the United States what it is going to decline over time. And that's, probably not irrational to argue that on a relative basis. Yeah, we might decline in the long run, but is this a crisis that's going to, materialize in the next 5-10 years? I mean, God, I don't think so. I mean, if anything, it looks like right now, it looks like the USA is sort of the runaway only innovator in a lot of sectors, especially when you look at things like tech. I mean, we've sort of monopolized the technology sector, and that's, arguably the most important thing going forward. So I don't see the crisis that everybody.
That's always my question. We have a $30 trillion economy. Who's going to knock us off that perch? I don't see any comers. Every 10 or 15 years, Japan was going to do it in the 80s and China was going to do it in the early 2000s. And they just don't have any of the built-in benefits that we have. And
it's just, that's the thing. It's just not even close right now. When you look at like foreign currency reserves held by foreign governments, I mean, it's 60% US dollars. The next one is the euro. I mean, is anybody worried about Europe overtaking the US economy anytime soon? The next rung down is Japan at 5%. China, everybody talks about China. China's at like 4%. It's just, there's nothing that even comes close to the dollar. So I sometimes laugh when people, out of all the horrible currencies in the world that you could pick on, the dollar is like the one that you absolutely should never short or bet against because it's the best of the lot. Even if you think that, the whole neighborhood is a bad neighborhood, it's the best house in the bad neighborhood. And it's the best house by a huge, huge margin. So I kind of liken it sometimes to like, if you could pick any company in the S&P 500 to short, would you pick Apple or, any of the top 5? Like there are 495 other companies that are probably better short prospects. And when you look at the world of fiat currencies, there are 150 other fiat currencies that are probably better to complain about, bet against, that have worse governments, worse underlying households and innovators. And the dollar is not the one that you should be betting against in the long run, I don't think.
And for people new to finance watching, MMT is modern monetary theory. Is that correct?
Right. Yeah.
Okay. And that's basically just that we make too big a deal about government debt. Is kind of the gist.
Yeah, it's kind of a heterodox, so an unorthodox theory that they sort of claim that the country's a reserve currency issuer that can never run out of money. So they kind of emphasize a lot of big government spending programs by virtue of arguing that, hey, look, we have a printing press essentially. So it's much more complex than that. But
okay, got it.
All right, let's do another question.
Okay, up next we have. Is government spending a crisis level worry or something that can be fixed? What are some simple fixes that could be made to rein in the spending? Or is there no stopping this train because Democrats and Republicans alike love spending money?
I mean, it does kind of feel like there's no stopping the train at this point. I know both parties will talk about reining in spending, but is the simple fix here just that the Fed lowers rates and that should help a lot? Like, how much will that actually move the needle?
It's a biggie. I mean, and it's an interesting one, especially in the context of the last few years, because the deficit was about $1.8 trillion in 2024. And I mean, roughly, 1.1 trillion of that or so was just government interest expense. And so if we actually took interest rates back to, say, 2 to 3%, you would immediately lop off $600 billion or somewhere in that range. And so the deficit would immediately fall to $1.2 trillion. And this is important because the overnight interest rate is something the Fed can control with a dial. I mean, they could quite literally, they could quite literally turn off that spigot tomorrow and it would immediately collapse down to, the deficit would fall to $1.2 trillion. And then, all of a sudden you're at, a deficit that's like 4% of GDP, which is, big historically, but not definitely not consistent with anything catastrophic. So, a lot of this can be controlled with a dial, but the interesting thing, especially with interest rates, is I think, especially in the last few years, is people look at that $1.1 trillion of net interest and they say, well, this is contributing to inflation. But the problem with that narrative is that you have to look at context. And the point of raising rates really is to suffocate borrowing. It's to reduce consumer demand through borrowing so that people stop buying homes or make it more difficult to buy homes, to buy automobiles, to buy large appliances. And that worked. It worked in a big way. The housing market is frozen. The auto sales are, slowed a lot. People are nonstop complaining about being able to get anything on credit, basically. And so consumer demand has slowed and inflation has slowed subsequently, even though we have this $1.1 trillion line item from interest expense. And I think that what's happened basically is that even though we're issuing more money through the interest income channel, it's more than offset by the way that the credit markets have been hurt by all of this. And so inflation has fallen despite having this huge deficit.
Right. Yeah. Yeah. It's kind of counterintuitive. Do you think there are other fixes in like entitlement programs where like the Social Security one seems like a simple, easy one to me, right? You raise the retirement age, you lift that ceiling on where people pay Social Security taxes. Does any of that stuff move the needle at all, or do you think that's just shifting around the deck chairs?
That's a really hard one because especially with the demographic problem, like if I had to guess, I would guess that Social Security and programs like that are actually likely to get larger in the long run because the demographic problem is just sort of, unavoidable in the long run. We're getting older, and the country is just, we don't have as many people in the long run. So you have this weird demographic issue where, like, I think that inequality is likely to actually get worse in the long run, which weirdly, and this is another thing that's kind of counterintuitive, it requires, I think, probably more government assistance for a lot of people in the long run because the income distribution is so uneven across the economy that you end up with a bigger government by virtue of basically the income not being equally distributed. And you've got more and more of all of this sort of, collapsing down into the corporate sector and the ultra high net worth people who are, sort of they're eating the entire financial wealth of the world over time.
Yeah, that makes sense. Now, let's say we did get into a crisis situation where the Paul Tudor Joneses of the world say, like, people are going to go on strike and not buy the treasuries anymore. I don't think that's going to happen. Let's say it does. Would it be simple enough for the Fed or the Treasury just to buy their own bonds like Japan is doing? Because doesn't Japan own something like 80% of their own government bonds? Isn't that the kind of thing where, yeah, that would be not the greatest situation in the world, but we could still figure it out?
Yeah, it depends. So, are people not buying T-bills? I think that there's a difference here. I mean, the demand for like long dated treasuries has declined in recent years relative to something like short dated. But if the government, let's say they just stopped issuing 30-year treasury bonds and they only issued T-bills, are people going to stop buying dollars that basically pay 4.5%? I don't see it. I certainly don't see it in my business. I don't see it personally. And again, this goes back to an inflation debate. It's not that there's a worry over the AAA rating of the United States and the T-bills. You really don't have to ever worry about whether a T-bill is going to mature at par. What you have to worry about is whether you're earning really a real return on that. And there's a big difference between a central bank like Zimbabwe, which goes in and starts buying its debt because there's quite literally, like, there's no demand through, which is basically being priced through inflation. And that's the right way to think about inflation, is that when inflation is really high, the demand for the currency is collapsing. So you can think of that almost as like a corporate interest rate in essence. It's the interest rate on what the government can afford. And when inflation is super high, it means the demand has collapsed basically. And so you're back to an inflation debate there. And so you have to again ask, does Paul Tudor Jones think that really high inflation is coming to the United States? That's a debate that's worth having, but it's different than a solvency debate. And if the central bank is buying bonds because you have hyperinflation, well, that's very different than a situation like the United States in 2008, where the government is quite literally buying the bonds because you have deflation. It's virtually the opposite. And that's what happened in Japan for a long time, is you had deflation. The government was trying to change the composition of the outstanding financial assets to change the demand for them. That's a very, very different scenario than one where you have a hyperinflation or even a very high inflation and the government is buying back its own bonds.
Yeah, in our hypothetical situation, your solution was way easier than mine. You just said change the maturity profile, and that makes a lot more sense to me too. To your point, okay, if no one's going to buy the long-dated debt, we're going to issue a bunch of short-dated debt. Are people really not going to buy that? I agree with you. There'd have to be a really big crisis scenario to make that not favorable for people.
Yeah, you'd have to have, it would be reflected through a foreign exchange collapse. So you'd have a dollar crisis, and you'd be having essentially a hyperinflation during an environment like that. And that's a relevant debate. We can, especially looking back at COVID, like I sent you guys a chart of government spending as a percentage of GDP. And this puts things in perspective nicely because you can see we're kind of back to basically a normalized level, more or less. Especially if you backed out the interest expenses here, it would actually be lower. It'd be much closer to the pre-financial crisis level. But the kicker here is that when you get government spending that goes to 45% of GDP, that causes bigly inflation. That's the lesson from COVID, really. And if we were to get something like that where you got 35, 40% of all GDP was just the government printing money and spending, yeah, that would worry the hell out of me. That would cause huge inflation. A persistent government spending expense like that would definitely cause big time inflation. The situation we're in now, it definitely causes some inflation. Does it cause really high worrisome inflation? I don't think the evidence is there to support that.
Here, let's get into the next one because this is more about the markets too, and I think it's interesting
First, I wanted to share my $1 billion from Zimbabwe. I have,
God, you're so rich.
Light it on fire, Duncan.
I had no idea you were so rich, Duncan.
Yeah, I'm a billionaire there.
Where'd you get that from?
Like eBay or something.
He bought it for 2 cents on eBay.
Yeah. Okay, now we can go to the next one, Dan. All right, people keep saying the only reason the stock market is up is because of the deficit. How much of an impact does the deficit have on financial markets?
So the 2010s, I feel like you fought this narrative a lot too. People would say the only reason the stock market is going up is because of money printing from the Fed. And now the 2020s, the people who are angry about the stock market going up say, no. The only reason the stock market is going up is because government debt levels and the deficit. So obviously these things, fiscal and monetary policy, have some, there's some reaction function there. But to say that it's the only reason, I want to hear what you have to say on that.
Yeah, I mean, it matters a lot. And I would argue it especially matters in a crisis period when private sector spending falls and you get these huge, like 45% increases in government spending as a percentage of GDP. That has an outsized impact. So you had these acute environments like 2008, 2009. The Fed's policies, like I would argue QE had a huge impact in 2009, but had very diminishing returns as the years went on. So the environment depends. But we also know that, one of the dirty secrets about big deficits is that, especially in the United States where the personal savings rate is relatively low, there's an equation called the Kalecki equation. And this equation basically shows where corporate profits come from. And one of the big items inside of this equation is government deficit. So when the government expands their balance sheet, think of it as though the government just, printing money, for instance, rather than, ignore issuing bonds, just think of them as printing money. Where does the money flow? Well, the money flows somewhere. And if households save the same percentage as they did before, so all else equal, the money will flow eventually to corporations. So in 2021, I remember after we printed, $7 trillion across a couple of years, I remember thinking to myself, I wrote this on Twitter, that, hey, corporate profits are going to hit record highs in the next few years because U.S. consumers don't save, the savings rate's going to collapse, and corporate profits are going to boom. And when they do, stock prices are going to follow. They're going to follow in part because of what the government did, but they're also going to follow because, you got to, again, dig deeper. Like the Chinese economy is a great example here, where the Chinese economy, I mean, they've printed their own trillions of dollars over the last 10 years. What has their stock market done? It's been a zero for 10 years. That's because there's other factors at play. And the main one there is that their corporations have been diluting the heck out of their stock market. And so it's a totally different scenario where, and God, I mean, Europe has been doing QE and all these things. Their stock market has lagged. So you have to start looking, at what's unique about the United States. The big unique factor is that, well, we haven't diluted our shareholders. And yeah, there's been a lot of money printing, but at the same time, there's been a heck of a lot of innovation in the United States that has made the United States an unusual economy, and in the corporate sector in particular has boomed because our corporations are they're so massively productive and innovative right now that the profits and the stock returns have accrued to the United States because of that.
Corporate America is the one institution I still trust more than anything else. Right? The way that they allocate capital and how, because to your point on the China thing, China printed a ton of money, the stock market didn't do anything. In Europe and Japan, they had interest rates negative. Did they get a booming stock market? No, they didn't like us. So yes, the fiscal and monetary policy is one input, but if it was the only lever you could pull, guess what? Every government official would do it, and they want to boost the stock prices to make people wealthier. But it's not the only thing.
And that's the thing. Printing money does not create wealth. So this is something the MMT people sometimes love to say this. They literally will call government debt equity sometimes, that's a big no-no in terms of accounting. When you print money, you are not printing net wealth. You're not printing equity. You're printing money, and the money, it depends on how you use that money. And the American economy, for all its faults, despite all the health issues and social issues we have and the disagreements in politics, the one thing we're really, really good at is making stuff, innovating stuff, and trying to make money.
And then spending on that stuff. Right?
And spending money, yeah. I mean, we're such an enormously wealthy economy too, in part by virtue of the fact that our corporations are worth so much because they're so innovative and valuable that that's the dominant factor when you think about why is the stock market booming over the course of the last 10 years. And that's not to say that the government and the Fed and all this intervention plays no role, but is it the singular factor in terms of causality? I would argue definitely no, that it's a factor. But again, and this is the same thing with inflation. I think people love to look at inflation and then point to the government or the Fed and say they caused all of it. And sure, they definitely caused some of it, but especially in a normal economy like right now, it's much more complex than that. There's other factors that are dampening inflation and having different causes, that it's not just the government that's causing all of this. So you have to be careful looking at this one singular factor as the end all be all.
Bitcoin fixes this?
No,
I'm
no.
just kidding.
All right, speaking of inflation, we got a good one on inflation next.
Okay. Up next, we have the most glaring risk of a Trump presidency from an economic standpoint is tariffs. Every economist seems to believe this raises the risk of inflation. Please explain how this works and what the potential ramifications are.
So this week, my wife was watching the news and she said, so what's up with the tariffs? What are these things all about? And I think that's probably where a lot of people are. If we're talking like civilians who don't pay attention to this macroeconomic stuff all the time, how do you think about the potential impact here?
This one, I think, is impossible to analyze. I mean, me personally, if Trump actually goes through with all of the tariffs, I read a report from, I think it was JP Morgan yesterday. They said that the rate of inflation, they would add 1% to inflation per year, which that's a lot. So if we're at, 2.5-ish on inflation right now, and Trump implements all of the tariffs, it would raise inflation to like 3.5%. Is he really going to do this? I don't know. This is, to me, I think when you look back at Trump's first term, it's really interesting that a lot of people were worried about the same issue back then. And even the tax cuts and everything that he implemented, the big deficits, did inflation flare up then? No, inflation was actually really low throughout the entire Trump term. I mean, of course, when COVID happened, it really collapsed. But and then the response to it, I think, caused high inflation subsequently. But before COVID, there was just barely over 2% inflation per year under Trump. So that to me is the baseline scenario working going forward. And I think that, personally, I think Trump is going to use this as a negotiating tactic. Trump likes to be able to walk into a local business and say, hey, are you making all of these automobiles here, or are you outsourcing all of it and hiring foreigners? Because how would you like to be slapped with a 20% tariff if you don't start bringing all that work back here? And so as a negotiating tactic, I think that's what Trump likes. I think he likes having this sort of negotiating point where he can go in and sort of bluster and be loud and be the art of the deal guy, basically. And so is he really going to implement all this? I would be surprised if he does. It will definitely add to inflation. Will it add to inflation in a way that causes, really, really high, dangerous inflation? No, but it'll force the Fed probably to stay tighter for longer. It'll be messy for the bond market and stuff like that. So, but again,
you would see prices rise on certain goods. If he puts a 30% tariff on imported goods from China, for a lot of products, you'd see an immediate rise in price. Like corporations are going to pass that along.
Yeah, for sure. And that's the other question is that, if he did these broad, huge, sweeping tariffs, the question then becomes is corporations can try to pass along the tariff, and the question then becomes well, is the U.S. consumer in a position where they can actually eat that cost increase? I don't know. We've never seen anything like this, so it's a curveball. It's one that's really hard to analyze. I think the baseline assumption should be that if he implements all of the tariffs, you get a bump in inflation. Doesn't cause hyperinflation or anything like that for sure. I actually wouldn't be shocked if the tariffs and a lot of the cuts that they're going to ultimately implement, I wouldn't be shocked if a lot of this causes more recession risk than anything else, actually, that the price increases aren't sustainable, that the cuts, especially, it looks like the way that they're starting to operate, that they're going to cut a huge number of departments in the government, which, again, could be a great thing in the long run, but I wouldn't be shocked if it causes some bumpiness in the economy in the short run.
Yeah. So the best case scenario to Trump's tariff plan is just the idea is to reshore, to bring a bunch of manufacturing back to the United States. Is that the idea?
That's the main goal, is to bring employment back so that corporations aren't outsourcing. Again, how likely is that? I mean, I think in the long run, this is a one-way train. It's just that the global economy is so interconnected now. It's so easy to outsource work. I mean, I hire people that work in India now just through like TaskRabbit and things like that. Like it's so easy now to outsource work that, is Apple really going to onshore all of their foreign made goods back to California? There's no way they're going to.
The wages are probably 10 times higher here.
Yeah,
so that would be inflationary, right?
They're going to move it to, even with a tariff, they're going to say, oh, well, okay, well, the Malaysians are willing to make all of this stuff for 30% less than the Chinese. So we'll move all of our manufacturing to Malaysia, and that will offset the tariff. I mean, the likelihood that we're going to onshore all of this, I think, is just extremely, extremely unlikely.
Yeah, that's a massive shift. Duncan, what Trump really wants is you can't watch F1 anymore. We got to bring those sports back to America.
F1's entire schedule takes place in the United States.
All right, we got one more question.
Okay. Last but not least, I'm having trouble figuring out the right narrative for interest rates. On the one hand, it makes sense that rates are rising right now because economic growth remains strong and there's a risk of inflation reaccelerating. On the other hand, demographics and technological innovation are deflationary and should put a cap on rates. Which line of thinking makes more sense?
So I think this is parsing through the narratives on like the short term and the long term versus rates. Like rates go up, it's bond vigilantes, and rates go in a better economy, and rates go down, and it's worse economy and recession, and trying to figure that out. I think investors are a little too quick to take the direction of rates at any one time and just slap an economic narrative on them, when most of the time it's probably just positioning by investors. And so the best take I heard about why rates are rising now is, well, the risk of a recession has kind of gotten pushed out and taken off the table, so people didn't need bonds as a hedge anymore. And that made way more sense to me than inflation is coming back and all these other macroeconomic worries. So what do you think about because I agree that long term, the demographics of this country and the fact that technology is deflationary should mean we're not going to get super high rates anytime in the future, barring some unforeseen event.
Yeah, I think that's right. And yeah, you do. You kind of have to look at this across two different time horizons, I think, because like my baseline macro scenario in the long run is the one that you just sort of mentioned, where the demographic trends, inequality, and technology, these are hugely deflationary forces in the long run. So it would take something truly gigantic in terms of like government spending. You're talking, again, going back to like the 35%, 45% of government spending as a percentage of GDP, or some other unforeseen factor. A collapse in U.S. productivity and output would do it. Is that going to happen? Unlikely. So my sort of baseline scenario in the long run is, interest rates are likely to remain low because inflation is likely to remain low, just because of all these huge macro factors that you don't have a big offset. In the short run, it's a lot more complex. I mean, I like to use the analogy of, people talk about bond vigilantes as if like the bond market is this thing that sort of like whips the Fed around. And I don't think that's quite right. I like to think of the interest rate market as like a man walking a dog, basically. And the 30-year bond is basically like the dog on a leash. And the Fed is the person walking the dog. And the way to think about interest rates is that the Fed holds that leash and has absolute control at the handle. And so if you think of the yield curve as sort of like the dog being able to wander out further out, what's really happening there? Is the dog walking the man, or is the man letting the dog walk out in front of it? And I think that's a good analogy for the way that the Fed operates relative to like 30-year bonds, because the 30-year bond is really, in my view, it's like a guesstimate about where the Fed is likely to head. And the 30-year bond traders are, they're looking at things like inflation and Fed funds expectations and things like that, but they're not controlling where the Fed is going. In fact, if the Fed really wanted to, the Fed could grab that leash, it could reel it in, and it could grab that dog by the neck, and it could take the 30-year Treasury bond and it could say, all right, I'm going to set you at 4% in perpetuity. And guess what? I've got a bottomless barrel of money, and I'm going to set that price. And there's no way you're going to be able to fight me. So you can scream bond vigilantes and all that, but I'm the one with the bottomless pit of money, not the bond traders. And so there's a little bit of a difference in terms of like in a high inflation environment. I think you could probably, using the same analogy, you could say, well, the dog in that scenario is really big. The dog is strong, and the Fed has to do something very different to sort of rein it in, because the signal it's sending back to the Fed is different. But in general, the Fed very much has control over the direction of the yield curve, and you don't have to worry about, unless you have a sort of super high inflation environment, you don't really have to worry about the Fed being out of control across the yield curve.
I have a 4-month-old puppy at home, and I'm still working on my Jerome Powell impersonation. I'm still trying to be the Fed and teach her not to bite the leash while she's walking, but we're getting there. We're not quite. She has more control over me still, but we're working on it. My favorite
story of all time is one of the very first interviews I ever did was about gold. And this was back when I had a puppy 15 years ago. And she walked in the middle of the interview and she took a humongous dump right on my foot. And I had to sit through a 15-minute interview with this stench coming up. So yeah, maybe the dog has more control over us than we think.
Yeah, I feel like that's a metaphor.
I think your dog was not happy with your macro takes. And so if anyone has any hate mail for Cullen on government debt levels, where do we send them? Where do we find your work these days?
The email is joshbrown@gmail.com for all the hate mail.
But what is it, disciplinefunds.com? What's your new website?
Disciplinefunds.com. Check out the Discipline Alerts tab. That's where I blog and write about all this stuff. But you can also email me at cullenroche@disciplinefunds.com if you have something nice to say.
All right. Cullen, we appreciate it. This was great. Very pragmatic. I wonder where we got that name from. Our email here, askthecompoundshow@gmail.com. We love all your questions and comments. Subscribe, rate, review, all that stuff. If you leave a review for us, that'll make Duncan's week.
It will. Yeah.
Right.
We're climbing up those charts. Help us climb.
All right. Thanks, everyone. See you next time.
See ya.
Thank you, guys.